Turn this mic back on. Okay. So now you can hear me? Okay, so I got this thing going on in the background. All right, I just can't hear you guys. I can barely hear you at all. I don't know. There's definitely something going on here.
Okay, so we'll just flag you if there's a comment in the chat.
Okay, yeah. I'm just going to hang up on the phone because I'm getting feedback on the phone. All right. Well, sorry about that, folks. Unfortunately, I don't know why. What's happened? It is really weird. Anyway, thank you very much for inviting me to come, Rob.
Okay, it's our pleasure.
Did I speak to the good? All right. So did you do an intro?
No, we sent out an intro to everyone.
Okay.
By email.
All right. Some of you know who I am. I know Mike and Ryan and Peter and Natalia. I think I've met you on other events as well. And Jasmine, I think, was on last week when I joined you guys. All right. So I'm here to talk a little bit today about private lending. Let me just share my screen. Okay, now where is my... All right, can you just give me a thumbs up to let me know if you can see my presentation? Now, all of a sudden, you guys all disappeared. Why did you guys all disappear? Well, that is weird.
We can see it, Shelley. We can see your screen.
She can't hear.
There we go. Okay, now we're off to the races. I can see you and see the presentation. All right, so I'm here today. Robert and I have known each other for a long time. Some of you, we've known each other for a long time in our many different lives that we've had as a real estate investor. So I'd like to thank you very much for letting me join you today, Rob, to talk about private lending. So I'm going to talk a little bit about, how to access private funds when you need as a real estate investor. So my name is Shelley Hagen. I live in Calgary, Alberta. And as Robert know, and we're all very similar, we're all here because we're passionate about helping other people grow their business and sharing information that we have. I don't consider myself a guru in any way. I just have some experiences that I wanted to come here and talk to you guys about. I do want to give a disclaimer that I'm not an accountant, not a lawyer, not a financial planner of any kind. I'm going to talk to you some general information about private lending. I have been doing private lending myself. I started back in, when I first got started back probably in 2001, I started doing RSP lending, and I'll talk a little bit about that today. Right now, I'm part of a team, and so we know that I work with a mortgage broker, and I have a very large network of people. A lot of people have TFSA, RSP funds, etc. And they come to me and they want to get a better than average return on investment. And so I work with the broker. I used to have a mortgage broker license, but I don't anymore. So I work with a licensed broker, and where I find deals and find people who are interested in investing. She has a pool of people as well and deals. She does the underwriting because she's licensed at this particular point in time. But we've been working together for a number of years, and some of you are involved with that process as well. So I do recommend that you do have talk to a financial planner, an accountant, and an attorney. You're going to need an attorney to help you with this process. So Myself, I've been a real estate investor now for 25 years. Started back in 2001. I took my initial training back in 2000. I worked for Sastel at the time. I'd been there about 20 years and they offered a severance package. So we decided to go off and try something else. And I'm constantly looking for new ways to increase my knowledge. So things like this, sitting in on, lunch and learns is very important to me. Try to sit in as many things as I possibly can. When we first got started, I was leaving the phone company. Everyone was asking me what I was going to do because they were surprised that I was taking the severance package. And finally, I started telling people I was going to do real estate investing. And they said, so what is real estate investing? A lot of people didn't know. And so we're talking about it. And they said, well, how are you going to do that? And I just remember saying to them, I have absolutely no idea how I'm going to do it. But I said, I'm taking some training and I'm going to try to, and I'll figure it out. And I think that's an entrepreneur. That's kind of what it is. You can't possibly know everything to get going. You just got to jump in and get going. Right, Ryan? You and I have had this conversation before. And, you just got to go for it and do, try the different things and see what happens. So we were leaving good paying jobs, had no income. And so our motto was go big or go home. So the first year we invested in 96 units between Gatineau, Quebec and Regina, Saskatchewan. And since then I've invested in, Saskatchewan, all the Western provinces, as well as Quebec. And we were inducted, and as well, I've been investing in the US. I was inducted into the Hall of Fame in February of 2020, 2002, I guess. I've got experience down in the US since 2003, 2004. Lived in Arlington, Texas for a while, and in Phoenix, Arizona. Phoenix is my primary market in the United States at this point in time. But I have owned properties in Michigan and Nevada. And so I've done deals, I think, in 5 different states and 5 different provinces across the years. I'm trying to make life a little simpler for myself. And my goal is to move into private lending more as we go forward. So whenever I have cash, I want to invest it and try to get another income stream into my business. So I have owned probably over 200 houses and units of different kinds over time. A lot of single family, multi-units, commercial. I currently have a small 2.5 acre land development deal on the go here in Alberta. Wherever I can, I like to do flips. We started with the BRRRR strategy. I've done discounted notes, I wholesale, private lending, mini storage. I've done a wide variety of things. I wholesale, I teach wholesale class. I've taught that for years. And I've taught lease option class. Here in Calgary, lease option is one of my primary strategies. And I've done a variety of different things over the years. And I do teach in both Canada and the United States and do ongoing coaching on a regular basis. So I've been around for a while and done a lot of different things. So today, I'm here to talk a little bit about private lending, how to access funds yourself as an investor for real estate deals. And this is one of the things that I think is important. When we first got started, we did a lot of seller financing strategies in order to get into properties and some creative things, which I can always come back and talk about another time as well, if you want to. And then we ran out of, our own money, our own credit, and we had to start bringing in partners to help us out. And so we did private lenders eventually as we started going along. And that's been one of the keys to help us grow our business in doing that. So I started this with my business partner, Carol McConaughey, who is one of my best friends, and we still do some things together. So what is private lending? Well, basically, it's a non-traditional source of funding. So it's not a bank funding. And you probably have heard different words like hard money lender, non-traditional, equity lenders, private lenders, different different names for different things. So hard money lenders tend to be those companies that focus on doing non-traditional lending, and we call them hard money. But so Calvert Mortgage, how many people here have heard of Calvert Mortgage? They're big now in Ontario and Alberta. They've been doing business for a long time. I've known them for 20 years probably. Their head office here in Calgary, and they are very good to work with. I really enjoy whenever I go there. They're very fair and equitable people, I think. You are going to be paying higher fees when you're dealing with these things. So those hard money lenders are the guys and gals that are out there that this is their primary business. That's what Calvert does. They've raised a pool of funds. They went through securities. They have a MIC, investment corporation, that they've gotten through securities, and they have a group of investors that invest with them, and they give a certain guaranteed return. There's a few different groups like that do mix. And in the Toronto, Montreal area, there's tons of hard money lenders. So there's also then, and they would be considered equity lenders as well. If you're doing a Google search, you can look under hard money, private money, equity lenders. You can find them all over the place. So sometimes there's a group of people get together and they pool their funds and they lend the money out together out of a fund of some kind. And that is kind of like a hard money lender at a different level kind of thing. They all somehow share in that information. And that's their particular way of doing it. I also work with a lot of people with the friends, family, and close business associates, FFBA. So that particular program has been around for a long time. So I look for people within my circle of influence that have funds that are available to them. So, and it could be a variety of different types of funds that are having them. Typically, they're used for investment properties, business to business. Sometimes we do owner-occupied mortgages. So here in Canada, I will do owner-occupied. In the US, I only do business to business, just because the programs that are in place in a lot of states protect the homeowner more than they do the lender. And in Canada, we have a lot different litigation that actually does still give more protection for the lenders here. So you may do some debt consolidation loans or something like that. Typically, private lending is faster, more flexible, can be relationship driven compared to the banks. They can take a look at the scenario and make a common sense decision, where sometimes the bigger banks, they have such strict criteria within them because they have large investor pools that they have to account for, and they're much more conservative in how they lend. So a lot of private lenders that we deal with typically have cash. They're going to have their self-directed retirement accounts. So RSPs, TFSAs, LIRA, spousal RSPs, RESPs, RIFs, all of those can be used to invest in real estate. And so some of the people that I work with are, well into their 70s and still lending out their RIF funds. Some people are, just getting started and starting to lend stuff out. So when you're dealing with the self-directed in Canada, there are, rules and regulations in place with the federal government and with CRA as well, that as to how those funds can be lent out. And typically they have to be arm's length third-party mortgages. There is a program that you can use your RSPs to fund your own mortgage. A lot of people don't know about that, but that's an exception to the rule. Most of the time, if I'm going to get RSPs from somebody who's a family member, I can't borrow money from my parents or my siblings, but I could borrow it from a cousin as long as there's, enough distance between us. So parents, grandparents, siblings, you can't borrow the money from them. They have to go through a trustee. Olympia Trust is probably the biggest one now across Canada, but B2B Trust is very big as well, especially in Eastern Canada. Montreal Trust, Raymond James, and some of the banks will also do them, but they don't advertise that they will do them. And they don't necessarily want to promote it because they don't want you to take your money out of their mutual funds, right? Olympia Trust is meant to be a trustee in between. They don't have mutual funds. They just take your funds and they allow you to invest it in different vehicles that are approved through securities to be used for investing. So with that, though, you as a lender can't personally benefit from the loans and the collateral, the money that you make. So if I lend out my RSPs and I have one of you have a mortgage with me, those monthly payments come back to my RSP account. And I have the tax deferral up until I decide to take the funds out of my RSP account. Then I pay the tax at that point in time. TFSA, I can take the money out at any time and use it tax-free, which is great. We're over $100,000 now that people can get in there. So if you have friends, family, and close business associates that have access to funds that want to get a better than average return, they could possibly be people that can lend you money for yourself. You just need to have someone help facilitate the process. So there are some things that you can have out. If you're going to charge a lender fee, you can have the lender's fees come to you directly, but all other monies need to go back into those accounts. Some lenders have lines of credit that they lend out. I know some clients of mine that have like $500,000 line of credit and it's unsecured, but the lender or the bank knows that when they lend that money out, they will secure it against real estate. So that's why they give them such a large line of credit. They have excellent credit. They have a lot of equity in their home. They don't secure it it's unsecured line of credit. But they still will allow them to lend that money out. Some people have money in their business, from profits that they've made from sales that they want to lend out as well. Most of those lenders prefer short term. They like doing things like flips. They like doing bridge loans where they're short term things. And I'll talk a little further about that. So does anyone have any questions? I don't see it in the chat at this point in time. Nope. So far, so good. Okay. And you can still hear me okay? See the presentation? Okay, good. This is so weird not to able to hear you guys when I'm talking. So the private money fills the gaps where the banks often say no, right? As a real estate investor, one of my biggest banes to my existence is getting money. We were able to borrow money to buy 96 units when we first got started. But it didn't take long before the banks kind of went, oh, you've had a little bit too much. We need to see that you can actually do this. And since we got into this business, the lending criteria has changed dramatically in our country. And it's a lot harder to get financing now, especially in corporations, et cetera. But it's not impossible. But, as real estate investors, it is much more difficult to do traditional loans. So, and we want things that are not as dependent on credit. You want things that'll, be more balanced based on the income and the deal, so much as me and my income and my credit that's going to pay for it. So, and a lot of real estate investors have unconventional, income too. We have, we're not a traditional T4 employee that gets money, from our employer. We're self-employed. and the banks look at it as totally different than everybody else. And sometimes one of the things that I love working with the mortgage broker that I do, she's also a real estate investor for 20 years. And, she's just very creative. And her and I have some great conversations about how to structure deals to get things done. So we kind of learn from each other as we go along. Most of the time, we can get these deals done within probably 2 weeks. Sometimes the lawyers get a little panicky if it's a week. It's pretty tight to get things done in a week because you have to go through Olympia Trust and get their approvals and things like that sometimes. Or if it's cash, well, you do it much faster. And there's a lot more flexibility in that. And there's, as a result, there's multiple lenders usually available as well, depending on what kind of funds are available. So for example, some people come into us to get a loan and they might need 200,000. At this point in time, we might have 3 people to do that have money sitting there, but no one with 200,000 in total. So we'd have to combine people together to do that. And in Ontario, it's much easier to do that. We have mortgage administrators in Ontario, which allows syndicated mortgages. When you put more than one lender together, syndicate. So someone like Olympia Trust allows that to happen. But you can't take RSP funds, for example, and put it with cash and do one mortgage. You'd have to do 2 mortgage. I would do maybe a second mortgage and a third mortgage, one with Olympia funds, one with cash. And so it's can get a little bit dicey depending on what you're doing. The only time you can use both cash and RSPs together is if you set up a fund that you go through security, set up a fund to get funds from different sources, and then you can borrow those funds out from there. But on a traditional, deal, it has to be either one or the other, or you need to have 2 different mortgages to do the deal. So just so you know, again, the value in working with private lenders too is establishing a relationship. So I've had some people that I've worked with for years that I lend them the money over and over and over again because they give me a good return and always pay. And so there's some people that we work with that have multiple deals that come through us because they're doing flips all the time. And they tend to be, somebody that has proven themselves with the lenders. So some of you, anybody here actually done borrowed any private funds for some deals? Yes, Robert has for sure. Most of your stuff down east, right? You got all private lenders? Yes. And so the most common deal is going to be a fix and flip. So it's designed to be short term, probably 6 months. You can negotiate with the private lender too on how to make payments. So most of the time you're going to make monthly payments, but you can also make semi-monthly payments or bi-monthly payments or bi-weekly payments, whatever you want to have. So either the 1st and 15th or every 2 weeks based on your work schedule. You can pay quarterly, you can pay semi-annual, and you can pay annual. Most of the time on fix and flips, the investors want to pay when the deal is done. When I've done the property, done all the renovations, sold it, I want to get paid I'll pay you out at that particular point in time. So that's very common. Also, when the lenders lend money, there's different criteria as to how much they're going to lend to you. So, for example, when dealing with us, we can do up to, say, 90% of the appraised value, depending on what the deal is. So that could be enough to do the purchase plus some improvements. But again, depends on the market. If you're going to flip it, we could consider doing that. But if you're going to hold it, we're probably not going to lend you more than 80% because you need to be able to refinance afterwards and pay us out with the refinance. So we're always looking for what is your exit strategy that you need the funds for, so a flip. But then what's your exit strategy to pay out the mortgage? How quickly can you do that? Because we need to let the lenders know that as well as part of our analysis of the deal. So also there's quite often a requirement for a down payment loan. This can be tricky now in Canada, depending on how you do it. It is somewhat difficult to get that down payment loan because if you're using a traditional lender, they don't want to, on residential especially, they don't want to see a second mortgage. And if you're using someone like Olympia Trust, the max they will go to is 90% of the appraised value or the tax assessed value. So they can be a little more difficult, but if you're doing all private money to start off, there's ways you can still do that as well. Or maybe you get, cash from somebody that you seize in your bank account, and then later on you take them out with a down payment loan, replace the down payment loan with another down payment loan. Bridge financing, as an investor, I like these bridge finance loans. They're short term. You're probably going to pay a little higher interest as a result because the investor is not going to make a lot of money. But a bridge financing fills that gap. So let's say I'm selling something, but I want to buy another investment property, and it's going to be, a month after I'm buying the new investment property before I sold the other one. So I may need some funds to fill that gap until the other sale is completed. So this is very popular within investors. They're short term. I can turn my money a couple times a month. It is important. And you got to look at what's in it for the investor. The investor, if they're not lending their money out for very long, they're going to want a better interest rate because they're taking their money out of the pool and putting it in with you. And it might only be for a month. Well, if I could lend that money to Natalia for 6 months and get more interest that way. So I'd much rather do that. So my incentive is that in order for me to do that, I'm going to charge you a higher interest rate. So I hope that makes sense. So the question Natalia had, are the private loans typically first mortgage? No, they're quite often their second. We will do a first mortgage for like a purchase to do a flip perhaps. So we'll do, up to 80% or 90% of the purchase price, possibly more. If the after repair value is substantially higher, we might do up to 80% of that after repair value or the appraisal. So regarding the appraisal too, you can get an appraisal done. If you're doing flips, when you do your appraisal, when you're talking to the appraiser, you want to make sure you have the appraisal done for as is and as if. So this is what it's worth today. It's worth 300, but if you do all this stuff you're supposed to do, it could potentially be worth 500. So you want both of those included in that appraisal. Someone like Olympia Trust is only going to take the as is, but it's good to see for them to see that it has potential to be 500,000 down the road. So you can, make sure you identify that up front with your appraiser when you're doing that. We also do, you can also do construction, renovation loans, BRRRR. Land development is not something I typically get into. There are very specific private lenders that deal with land development. Those are big projects. They're, usually multi-millions of dollars. Typically, we deal with stuff that's anywhere between 50 to maybe 200,000. That's kind of like the usual private loan that goes out. But there are people that do bigger ones. We do help out with the BRRRR strategy. People want to buy it, where they can get it cheap, do some renovations, rent it out, get higher rent and income on the property, and then refinance it and then repeat on that deal. So BRRRR strategy is very common for private lending as well. So debt consolidation, we'll do some of that for homeowners. Sometimes just doing a little bit of cleanup of some debt, consolidating it, getting paying it off quicker, helps them refinance and get things later on. You could, that could be a way to get some equity out of your property to use for a flip as well. The only thing with it is keep in mind is that if I'm taking out some equity to use for a flip, it has to be secured usually if you're using RSPs, TFSA against the property. And then when you pay that out, you've paid it out, the money goes back. So you have to do that over and over again. The costs are going to be higher. I'd recommend that you work to get a HELOC with your local bank or through a mortgage broker to give you more flexibility, because you can keep that HELOC there longer term and then use it, only pay for it as you use it when you need it. As well, when you're doing the financing, if you have, multiple properties, and if the deal's a little tight, then typically we're going to probably get additional security. So your primary residence might be this flip property or a rental property that you want to renovate so you can sell it eventually. Well, we might take 2 rental properties to secure it against there as additional security to protect the lender too. So, and you can do, let's say you have 5 rental properties that all have equity and you want to get money out to buy another investment. You could do a blanket mortgage over all 5 properties in order to get the equity, in order to help you buy another multi-unit or something. So there's many different ways to use the funds depending on what you need and is it the best use. So I had someone come to me recently that I know through my networking club. He needs about $30,000 or $40,000 to pay off some debt. And he has a house worth about $500,000 that's clear title. So he came to me and said, hey, can I do this? And I said, well, we could, but the cost is going to be exorbitant for you to do that compared to going and getting a HELOC. So private money doesn't fit every situation. As an investor, you need that quick cash. It's good. But, if you're a homeowner, and you want to get money out for paying taxes or stuff like that, and you have lots of equity and good credit, probably better just to go get a loan through your bank and do that. So we fit a niche, but not for everybody, right? As you're going forward. So when you compare the bank to private lending, the bank is certainly much more strict in their underwriting. Private lending is much more flexible. The bank is more income focused. Private lending tends to be more about the asset and the deal. Certainly, you do need to have good credit too, especially if you're going through something like Olympia Trust. Banks can be slow to approve. Private money, you can get it done much quicker. You're going to get a much better rate, and you are going to pay higher rates when you're dealing with private money, for sure. But it fits a niche. So typically when I'm talking about private money, I'm talking about debt lending. So that's where I go get a mortgage. I'm going to pay you, X amount of dollars per month. And at some point in time, I'm going to pay that loan out and it's done. When you're doing equity lending, maybe I'll bring in a joint venture partner who brings some money to the deal for my down payment, renovation costs. And then I'm going to give them a portion of the equity out of the deal when it's done. So they're going to get all their capital back and say anywhere between 20 to 50% of the profit on the deal. So there's a difference between the two. Typically, when I'm talking about private loans, I'm talking about debt lending. Does anyone have any questions? No, not at this point. Okay. All right. So one of the things to keep in mind as the borrower is that you also are responsible for all the fees. And there are, fees can add up depending where you're at. For example, in British Columbia, you have to use 2 lawyers to do a private loan. You have to have somebody represent the lender and somebody represent the borrower. Whereas in most of the other provinces, you can have 1 lawyer represent both. For example, on a Olympia Trust loan, possibly in a cash, you might need two lawyers. So your legal fees are going to be a lot more expensive in British Columbia compared to like Alberta or Manitoba, for example, where we typically lend in Western Canada. I have not done any loans in Eastern Canada at this particular point in time. I have borrowed money in Quebec, private loans. So your lender fees are going to be typically 1 to 2%. Now, if you're a Olympia Trust lender or B2B trust lender going through a trustee, the trustee has fees that they charge the lender. So there's a fee to write the mortgage, usually around $200 plus GST. And then they charge a fee per month. At this particular point in time, I forget, I don't know what B2B's is, but with Olympia Trust, it is $18 a month that they charge. All those fees get paid by the borrower, but that's usually covered in the lender's fees. So lender's fees, 1 to 2% will cover those Olympia Trust fees, at least for 1 year. If you extend past 1 year, do expect that you're going to have renewal fees, because that lender needs to get, reimbursed for those fees for the next year. If you're dealing with a broker, not always they're going to deal with a broker. If you're going to deal with a mortgage broker, it's probably going to be additional 2 to 4% on top of there. And your interest rates are going to be anywhere between 10 to 18% on the deals. Most often, probably 12 or 14 is typically what we lend out. But there are lenders that will lend out 18. One of my friends is a very big lender. He lends out probably about 15 million per quarter, and he has a pool of people that have come into his fund, and his fees are exorbitant. His interest rate in a lot of cases is 18 to 20%. So depends on where you're at. You can also go to some high lenders, like pawn shops and stuff like that. They lend over 20%, and they have to have a special license in order to do that in most provinces. So 10 to 18%. If it's first position, you may be able to get 10%. But if it's a second or third, you're going to be looking at 12 to 14 minimum in order to do that. Some of the hard money lenders have an administration fee you have to pay up front as well. And not all of them, but some of them do. And that's just for them to do their due diligence on the project. Sometimes you get that money back. Or if they do go ahead and give you the funds, they will include that administration fee in their lender fees. So it depends on the lender. It varies from one to the other. Again, the legal costs for the lawyer work and the provincial title work needs to be paid by the borrower. You also need to get title insurance for both the borrower and the lender. So there's a separate title insurance policy for the lender to protect them. You may need an appraisal depending on the tax assessed value and how much money you're looking to borrow. And you need to keep in mind too that when the mortgage is paid out, the borrower needs to engage an attorney to discharge the mortgage from your property title. If you don't do that, it'll sit there indefinitely because the lenders don't take the initiative to do the discharge. They get their money back. They will give you a letter saying, yes, it's paid in full, but they won't do the discharge on the title. And as well, there will be different fees, administrative fees. There'll be NSF charges, probably anywhere between 100 and 150, maybe a little more for an NSF if you do default on a payment going forward. And so, expect that there's going to be additional fees that will be identified in your loan. You're typically going to get some kind of a term sheet from the lender that's going to identify all of these different things in it. And then you need to go through that and determine exactly if that's something you want to do or not. And, you know, if you do, great. If not, you may want to move on. Rob, you have a question? Sorry. Is there, I don't see the chat. Oh, Natalia, you have a question? It didn't pop up on the screen. Is it in the chat somewhere that I just don't see? Oh, okay, yes. So yes, a good point. Now with if I was doing this on my own, I would get the client, the borrower, to pull their credit bureau and provide a copy to me. And I would go through a application process with them. When you deal with a mortgage broker, they're going to give you an application to go through. They'll get authorization to pull your credit. I don't on my own have my business set up to do that, so I can't pull it. I have to rely on the borrower to provide me a copy of their credit. I do take a look at their credit to see where they're at and what's happening, especially if they're wanting debt consolidation. It's really important to take a look at the credit bureau. I will also take a look at the property and the deal. So what are you planning to do? So as part of my due diligence for underwriting the deal is certainly looking at the borrower. Where does the borrower live? If you're borrowing money to do a fix and flip and you live in Ottawa and you're doing it in Hamilton, then I'm going, okay, like, how are you going to manage this flip? Because you need to be on top of those contractors on a regular basis, because if you're not there, they're off doing someone else's job. So I'll take a look at the borrower, where they live, what their job is. Have they been doing this for a while? What's their experience in doing this? Do I feel that that's more risky because maybe they're the first time they've done a flip and they're getting into, especially in Ontario, you're looking at probably 500,000 plus for a property on average. In some of the other provinces, you can get properties, 300,000. So the amount of money that's going out can be, a bit of a concern if they're brand new. So I want to look at all of those things. I want to look at certainly their credit, and if they owe a bunch of debt and they have bad credit score and they've had a bunch of missed payments, then I have to wonder whether they have the ability to manage payments or not going forward. And there's ways I can mitigate that. I can actually make it so that from the loan proceeds, I take 12 months worth of payments in advance out of there, so they don't have to actually worry about the payments for the first year. And if they sell the property faster, they'll give a credit back of some of that money. So some of those things help mitigate the risk for me as the lender as I'm going forward. I also want to make sure things like the property taxes are paid. If not, I might make that a condition of the loan. They have to take funds from the loan to pay off the property taxes. I need proof of that. I need to make sure I'm in the insurance for the property named as a payable. If the property burns down, I want to make sure the insurance money is there to cover me as the borrower. And then I take a look at the actual property in the deal. So what are they doing? Do the numbers make sense based on that? So like, for example, I had someone come forward with a rehab budget, and they had it was 1,000 square foot house, and they had over $10,000 for flooring. I said to them, what kind of flooring are you putting in this house that is an entry level house? Like, what the heck? And he had just he'd never done one before. So, we then had to have a discussion around that. I had him go back and rework his numbers and come back to me, so the budget made a lot more sense. So that's just because I have experience in doing flips in the past and renovating properties after owning rental properties. So I'll take a look at those things. I want to know, okay, so what is your exit when you're buying the property? And what is your exit to get me out of the loan? How quickly is that going to be? What do you need to do in order to do that? And do I need to keep on top of you in order to do that as well? So I look at many different aspects: the property, the borrower, the market. Also, do those numbers make sense with the market? What's happening with the market right now? And the exit strategy, and see if those all make sense. Does that help, Natalia? Okay, good. All right. So, and you need to make sure, that you have those contingencies in place, because stuff happens. You get in to do a deal and possibly you get sick and you can't do the fix and flip. Maybe you break a leg or something and you were going to do the work yourself. Well, now you need to hire contractors. It's probably going to take you a month or two longer, or something that happens too. So you get have contingencies in there as a borrower and as the lender. As one of the things that is really critical is communication between the borrower and the lender. If you're borrowing money from me, I want to know, I want to flip on a regular basis, what's happening with the deal. How are you doing with your progress? And I'm monitoring maybe your Facebook, because you're probably posting, different things. Most of the investors that we lend to, they're posting on, Facebook, what's going on with their deals, because they're looking for more deals. And so they're advertising. So I want to know how things are going as you go along with things. If they're going to be debt consolidation, well, then I want to know that they're working with a mortgage broker, and at least 3 months before closing, before mature date, that they're working with somebody to refinance to get me paid out to move forward. So you need to put a few contingencies. And as a borrower, it's really important to keep the lender in the loop. If you don't talk to the lender gets anxious. If you're getting close to closing, they haven't heard anything about it. The flip's supposed to be done, haven't heard anything. You don't return their phone calls. It's not a good thing. So you need to make sure you're on top of it. So we're just about at the end of our time. So this is just typical. Borrower presents a deal. The lender evaluates the property and the borrower. The loan terms are negotiated. The borrower can ask, but the lender controls the deal. The lawyer prepares the documents. Funds are wired to closing. The lender receives their interest payments, and the borrower provides an exit via sale or refinance of the property. It's kind of a summary of what that was all about. Does anyone have any questions? Oh, and the security is secured on property. Yes. Do I have my coordinates in here? I don't, but I can put them in the chat. Where is the chat? For some reason, it looks different on my computer today. Oh, there we go, chat. So I'm sorry that you weren't able to hear me, or I couldn't hear you folks. It's just really weird. Not being able to hear everybody. Was the content valuable?
Do you have any other
Okay.
questions? Is there anything that Shelley
Sorry,
didn't
Jen.
cover that you'd like to know about?
One thing I did want to mention is that for security, we do always, have a mortgage on the property, and you have a personal guarantee built in there. We also register on the general securities. I have a general security agreement. I register on the personal property database in each province, so that if a borrower goes bankruptcy or something, the lender is notified. And certainly we talked about the insurance. With income properties, you do expect to have an assignment of rents as well. So in case something happens, the lender could take over managing the property. All right, so I'm glad you guys were able to come and join us today. Rob, do you have any thing you want to send?
There's a question.
The screenshot. Turn on your cameras. There we go. Got a couple of people. Okay.
Natalia, it doesn't matter if
Right.
it's an individual
Well, it's good
or
to see everybody. Some of you I've known for a long time. Right, Peter?
Mike. Would you mind
Yes.
turning your camera on? Jasmine,
We've known
if,
each other
if
a
just
long
for a
time.
second.
And same with Mike. Not as well. All right. Well, if there's any other questions, should the borrower be an individual or the company? So very good question, Natalia. It depends on the deal. If you're borrowing the money for your personal use, then it would be certainly in your personal name. But if it's for your business, for a flip or income property, I'd recommend you put it into your corporation. Now, you do sign a personal guarantee, but you certainly still have that. The battery's almost dead. You could write off all of the everything of the expenses and everything through your corporation. Helps save you some tax. Whereas you can't necessarily do that on your personal properties. Okay. Any other questions?
No, that's it.
All right. I'm not sure why my speaker wasn't working. I was just on Zoom calls all day yesterday. I was on Google Meet calls yesterday. Didn't have a problem. Don't know what happened today.